This week's chapter is on fraud and social engineering. So this week we'll be covering elements of fraud, categories of fraud, types of fraud that happen, legal considerations, those who do commit it, the most expensive types, red flags, also looking at social engineering, segregation of duties, and 3 stages of fraud investigations. There are multiple types of fraud: internal, basically anybody inside of your company who does the fraud itself. It can happen by social engineering, which is incredibly successful. Smooth talking. One of the reasons I actually got into cybersecurity is because of a bio about a person named Kevin Mitnick, who is one of the most infamous social engineers of all time. If you ever want to look up his stuff, he has a few books out there that cover how he did all of that. After fraud, you see many times there are problems such as losing revenue through theft. Many frauds take long time to go through. Internal fraud basically says that the employee who is there and says that they're going to be doing good things for the company doesn't. They try to go through and set everything up for themselves and steal money. Misappropriation, that would be leading money else into wrong places. Bribery, trying to get people to spend money when they shouldn't. Financial statement fraud, if, say, you get a certain number of dollars per day for expenses and you don't spend that much, but you still try to claim that much, that could be expense fraud. Ways you can do it is something like skimming, larceny, embezzlement, tampering of checks, sending to false companies, manipulating your hours, bad orders, and inventory. It's not just an American thing. This happens all around the world. Illegal consideration, they're not errors, it's intentional. It happens because of lying and concealing. It's unethical, obviously. It's immoral, it's illegal, and generally the person is trying to get a benefit from it. There are multiple elements for this: motivation, opportunity, and rationalization. Most of the time, fraud gets found out by someone else telling people about it. After that, it's an internal audit and then review of management's. It's pretty tough to detect otherwise. Tip hotlines. With and without, you can see here the difference. $100,000 to $200,000 and 12 to 18 months between discovery. Collusion is when multiple employees or vendors work to defraud a company. And usually the more people there are working, the more people, the more money that can get taken. Of course, optionally as well, the more people working, the more chances to fail there are as well. Managers usually are involved in most of the incidents. Higher percentage of men versus women, still higher in every area. And the longer an employee's been there, the more they seem to be willing to steal. Fraud comes through multiple areas. Manufacturing, for example, is corruption. In fact, corruption is top for all of them. After that, you get billing and non-cash. Those get flipped back and forth through the majority of them, but every once in a while it's cash on hand. What type of fraud could a computer programmer or administrator commit? Example of that could be rounding errors. Recognizing fraud. Preventing fraud in info systems applications. Audits aren't supposed to find fraud. They're supposed to find out where a financial statement is correct. Auditors don't test everything. They have to be looking for patterns, but they need to know that it can happen. Other red flags say people living beyond their means, if they're facing financial difficulties, friends with vendors or customers, nepotism, anything that looks like they might need money for something. Bad work habits, performance goals, overproduction of documents, concealment methods. Most will fake evidence, will alter or destroy evidence, and they can also conceal it as well. Some usual transactions you might see: multiple timings, high or large or small amounts. If you see 100,000 transactions for 3 cents a piece, that's a little weird. If you see one transaction for $30 million you're not expecting, that's also weird. You need to look at all of things like that. The best time to control fraud is before it ever happens. Of course, that's not always easy, but it is a way to help prevent it. One of the big ways is segregation of duties, keeping one person from having every job. So the techniques here: give people job expectations that make sense, give them adequate pay, make sure that they're trained, segregation of duties, have an audit department to do reviews every once in a while. Preventative, detective, and corrective. Preventative is beforehand. detective is during, and corrective is after. Segregation, like I was talking about. So you say you've got sales, they've got to go to management and distribution and quality assurance. Everybody has their one single job, and nobody does everything. That's not always possible, but it's best. And make sure everything gets tracked here, there, and everywhere. Reports them for misses and everything, detection patterns and pace for unusual amounts of patterns, such as that 100,000 3-cent transactions or the 30 million if that's not a normal number. Check computer logs for data. Software can check things, look for checks out of order, non-standard addresses, things like that. IT security, set that through physical security, again, duty segregation, monitoring, doing job rotation so that somebody doesn't do the same thing all the time, and examination of documentation. Another thing I haven't seen listed so far but is important is forced vacations. If you're forced to take a vacation, then somebody else has to take over your role and somebody else has to be able to look at your stuff. It's another form of accountability. Don't let people have checks if they're not supposed to. Give checks returned, make sure that the right people are the ones sending the checks, and make sure that they are all used properly in order and that none are missing. Social engineering. There are ways for it to be used. It can be used many breaches. It's always used. Email, sometimes you can even have it done in person. Very few people will take the bait, but it's enough that it will actually be successful. Pretexting is basically pretending to be somebody you're not. Phishing, we talked about that briefly last chapter. It's how people can get in and set up malware or using spyware or financial monitoring. Here's your phishing attack sequence. An email then gets clicked, installs some malware or ransomware. Pretexting is pretending to be somebody else important. It could be done through a phone call or something where it's like somebody calls and says, I urgently need this. The VP says do it. Or if they even say they are the VP, you might feel pressure to do so. Business email compromise uses that to grab credentials or make accounts. You can do impersonations for people in power. Perhaps ask for money to move accounts, as I just said in that previous slide. Incident responses. You can notify to request a reversal, file a complaint with the government, and hopefully be able to get your money back. Has about a 75% success rate, and you can monitor those trends and verify the orders. The red flags rule is look for things in potentially suspicious documents. Verify personal identifiable information on account activity. Make sure that everything is up to par as how normally things work. Check credit agency warnings and look for other sources. Verification and confirm they're who they say they are. Confirm they are who they are who they say they are working in. Confirm they're authorized to do this, and record that transaction in case something does happen. Organization security, classify your data properly, define your guidelines for behavior, and train them in roles they need to know. Fraud scams, this happens sometimes. You'll find somebody with a receipt, take something back up front, and ask for cash. Get gift receipts in the same way. Sales using fake UPC numbers. Scams, make sure receipts are marked correctly, buying item details. Prevent garbage bin access. Numbers, make sure your gift receipts are unique, and protect against shoulder surfing, based having somebody look over your shoulder or look for skimmers. On checks, generally they've got prevention features. You can see here they've got watermarks, void pantographs, chemical voids, microprinting, reflective hollow stripes, similar to the ones you see in your larger bills, security ink, and thermochromic ink. For an investigation, you can see what's happening, look at it from financial and operational aspects, see if controls exist, see for red flags, find transactions, and see if you can line those up with certain people who are doing the work. Once you do that, you can confirm a hypothesis by analyzing your evidence, collect more evidence, see if there needs to be possibly a trial if somebody's getting arrested, and establish things for prosecution. Computer forensics tools. One of the other classes you've probably taken had this in it. You can find secret files, look for encrypted files, check images in computer memory or on a hard drive, look for emails for specific information, and these are generally used in the early stages of an investigation. So basically, like I said, about 5%, The key elements are motivation, opportunity, and rationalization. Internal fraud, generally by employees. External fraud, generally by outsiders. Thanks for listening, and good luck with your assignments.